It's 2 a.m. Wall Street is asleep. The banks are closed. But $60 trillion are moving. No bank branches, no ATMs, no obvious regulator, and yet, this system is pumping through the arteries of the global economy like blood. You've probably never even heard its name. The shadow banking system. It's a market larger than traditional banking in many regions, and most people never see it. That's the problem. If you think money sits in banks, and banks lend it out, that story is incomplete. The real game is happening somewhere else. And today, we're stepping behind that curtain. Why does this matter right now? Because when the global financial crisis hit in 2008, the explosion didn't just come from ordinary banks. The real blast happened where the light was dim, where loans were being made without being called banks, where risk was being sold without anyone clearly owning it. And today, that system is bigger than it was then. More complex, more interconnected, more silent. Let's start with a simple question. What is shadow banking? In plain terms, it's a network of institutions and structures that do bank-like things without legally being banks. They take money, they lend money, they invest, they use leverage, but they don't operate under the same strict rules that govern traditional banks. Here you'll find money market funds, hedge funds, private credit funds, structured investment vehicles, major players in the repo market. Together, they form a parallel financial universe. So how does it actually work? Imagine you have $1 million. You could put it in a bank. But if you want a slightly higher return, you might place it in a money market fund. That fund invests your money in short-term lending, repo agreements, commercial paper, securitized assets. On the other side, a hedge fund might use those same assets as collateral to borrow more money. Then it invests that borrowed money. Then it uses those new investments as collateral to borrow even more. Layer on top of layer, paper on top of paper, promises built on promises. At each layer, there's profit and risk. Traditional banks are required to hold capital buffers. They must offer deposit insurance. They answer to regulators. In shadow banking, more freedom, more leverage, less transparency. And that's the attraction. Because if you're not legally a bank, you don't face bank-level constraints. Now let's look at the scale. Globally, shadow banking assets exceed $60 trillion. Some estimates place it even higher. It spans the United States, Europe, China. And here's the twist. Many traditional banks are involved too, just off their balance sheets. This is where off-balance sheet magic happens. In the 2000s, mortgage loans were bundled into securities, sold, rated, then used as collateral to borrow even more. As long as prices were rising, the system looked elegant, efficient, innovative. But when housing prices fell, those securities lost value. And because everything was interconnected, the entire structure shook. The real problem wasn't just losses, it was the collapse of trust. Shadow banking relies heavily on short-term funding. Money borrowed today that must be rolled over tomorrow. If investors suddenly pull back, liquidity evaporates. And when liquidity disappears, everything freezes. That's what happened in 2008. So the question is, did we learn? Some regulations were introduced. Structures were modified. Some names changed. But the core incentive didn't. Capital always seeks higher returns. Higher returns usually mean higher risk. And if that risk can be shifted outside the strict regulatory perimeter, returns stay attractive. That's the heart of shadow banking. Risk doesn't vanish. It migrates off balance sheets, into funds, across borders. And here's the quiet irony. When everything is stable, this system boosts efficiency. Companies get funding, markets stay liquid, capital moves fast. But when stress hits, who steps in? The central bank. Profits are private. Backstops are public. That's the unspoken arrangement. If shadow banking is so private, why do central banks intervene during crises? Because when a $60 trillion market trembles, it's not just investors who panic. System feels it. In 2020, during the global pandemic shock, pressure hit repo markets and money market funds again. Central banks had to provide liquidity. Once more, the shadow turned toward the light. The public narrative says the banking system is safe. It's well capitalized. And in many ways, that's true. But it's not the full picture. The real vulnerability lives where complexity is highest and transparency is lowest, where leverage is layered and hidden, where short-term funding supports long-term assets. That's a structural fragility. Now look ahead. Private credit markets are expanding rapidly. Large companies increasingly borrow not just from banks, but from private funds. Those funds are slowly becoming accessible to retail investors. Risk is migrating outward, closer to ordinary portfolios, often without a full understanding of the system underneath. So when the next shock comes, where will it start? Housing, corporate debt, repo markets, or from a structure we haven't even named yet? Shadow banking isn't a secret conspiracy. It's a logical outcome of financial incentives. Tightens. Capital flows around it. Like water. The issue isn't that shadow banking exists. The issue is that we tend to notice it only when it begins to break. And maybe the real question isn't how big this $60 trillion silent market is. The real question is this: